Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Let's imagine that you have been given the responsibility of putting together a course on sensible long-term investing. What major subjects would you include in the course? I think you will choose the usual ones like financial accounting, economics, financial management, statistics, etc. Is this a wrong choice of subjects? I don't think so. The choice of subjects is bang on if you go by the conventional method of teaching. Any course on investing or finance would be incomplete without these subjects. But if legends like Warren Buffett and Charlie Munger are to be believed, any meaningful course on investing should have only two subjects as per them. These are how to think about market prices and how to value businesses. That's it. Buffett and Munger believe that anyone who has a good understanding of these two subjects can become a very successful investor provided he has the emotional discipline to implement them in real life. The first subject, that is how to think about market prices, is all about the famous Mr. Market parable that Ben Graham has so beautifully outlined in his landmark book, The Intelligent Investor. The main takeaway is quite simple. You should buy stocks from Mr. Market when Mr. Market is fearful, and you should sell stocks to him when he is greedy. But isn't this principle against the whole idea of the efficient market theory? The efficient market theory says that stock prices are always logical. In other words, as per the efficient market theory, Mr. Market is not an emotional fool. He is always rational, and therefore it is impossible to beat the market. As per this theory, if you have managed to outperform the market over a 3 to 5 year period, then you just got lucky and there was no skill involved. Now this is confusing, isn't it? Warren Buffett and Charlie Munger believe that Mr. Market is not efficient. Mr. Market is an emotional fool, and if you have to beat the market, you should be greedy when Mr. Market is fearful and fearful when Mr. Market is greedy. However, as per the efficient market theory, Mr. Market is rational and cannot be fooled at all. Therefore, you cannot beat Mr. Market, and any outperformance is just random luck and not based on skill. Well, I belong to the camp of Buffett and Munger. I do think that Mr. Market turns irrational from time and time, and you can take advantage of this irrationality and can certainly outperform the market over the long term if you are disciplined and invest based on a proven process. In fact, here's Warren Buffett himself throwing some light on this battle between emotional Mr. Market and rational Mr. Market. Observing correctly that the market was frequently efficient, they meaning academics, investment professionals, and corporate managers, went on to conclude incorrectly that it was always efficient. The difference between the propositions is night and day. So I guess Warren Buffett settles it, isn't it? Markets may be efficient, but they are frequently efficient and not always efficient. Let me repeat that. Markets are frequently efficient and not always efficient. Therefore, if you want to earn market-beating long-term returns, you should pay attention to stocks and sectors where Mr. Market is acting inefficiently and is either too greedy or too fearful. So that's the first subject, that is how to think about market prices in a nutshell. What about the second subject of how to value a business? Even here, Warren Buffett and Charlie Munger believe that you should stick to simple and easy over hard and complex. As a matter of fact, as per his own admission, forget an Excel sheet, Warren Buffett has never used even a calculator to value a business. On the contrary, if you are forced to reach out for a calculator or an Excel sheet while valuing a business, it is a sign that it's a complex business and you should not invest in the business. Valuation should be a simple back of the envelope kind of a calculation and it is usually such investments that end up giving market beating long-term returns. So that's lesson number 2 of how to value a business, where instead of the detailed techniques or principles, all you should rely upon is a simple math that can be done on a small piece of paper or even inside your head. The moment it starts becoming complex, the lower the possibility of earning great long-term returns. So those are the 2 rules or the 2 subjects of investing. How to think about market prices, where we concluded that markets are frequently and not always efficient, and you should look for stocks and sectors where the inefficiency is the highest currently. And the second subject was about how to value businesses where simple more often than not beats complex. Once you know these 2 subjects, it is all about practice afterwards. The more you practice valuing companies from different sectors and the more you study historical markets and try to study inefficiencies, the better you will get at the game of investing. Now let's try and use the 2 lessons we just learned on the following pair of companies. There's company A and company B, and here are the historical financials of the 2 companies. Prima facie, it does appear that company A is on a much solid footing than company B, at least as far as historical financials are concerned. In fact, company B has very poor financials. It has been loss-making for 4 out of the last 6 years, has an insanely high debt-to-equity ratio of almost 30x, and a very poor ROE of just 3%. Look at company A on the other hand, a stable if not growing earnings profile, an almost zero debt position, and a very impressive ROE of 48%. In short, company A beats the hell out of company B based on historical financials. However, investing is all about the future. Therefore, if we are to make good returns out of company A and B, it is also important to have an idea about the future of these companies in addition to the past performance. As Warren Buffett so eloquently puts it, if past performance is all there is to the game of investing, richest investors in the world would be librarians. Therefore, having a sense of the future does matter. Now, let's assume that company A manages to achieve an EPS of rupees 30 per share 2 years from now, and we give it a P multiple of 15x. A multiple of 15x is quite decent, to be honest, and cannot be considered too aggressive for a company that has sound historical financials like company A. Therefore, an EPS of rupees 30 per share and a P multiple of 15x gives company A a fair value of rupees 450 per share. Now let's consider company B. Can company B grow its EPS by 10 times by FY24? Well, given the company's past performance and its leveraged balance sheet and poor ROEs, achieving an EPS of rupees 30 per share by FY24 does look like a tall order. But let's assume it is able to do that by FY24. Also, let's give company B a P multiple that is twice that of company A, which is 30x. Now please know that company A has much better fundamentals than company B and therefore perhaps deserves a higher P multiple. However, we are doing the reverse here and giving company B a valuation multiple that's twice that of company A. So for company B, we get an EPS of rupees 30 per share and a P multiple of 30x, which gives us a fair value of rupees 900 per share 2 years from now. Here's the fair value table of the 2 companies. Company A an EPS of rupees 30 per share and a P multiple of 15x, giving a fair value of rupees 450. Company B also an EPS of rupees 30 per share by FY24, a P multiple of 30x and a fair value of rupees 900 per share. Now here's the shocker. Company A is currently trading in the stock market at a price of rupees 240 per share, while company B is trading at a price of more than rupees 2000 per share. Well, the question that you need to ask is whether Mr. Market is efficient in valuing both the companies, or is it being too fearful when it comes to company A and too greedy when it comes to company B? Please know that we have been conservative when it comes to valuing company A. We assumed an EPS of rupees 30 by FY24, whereas it has already earned an EPS of almost rupees 40 per share over the last 12 months. Therefore, achieving an EPS of rupees 30 in FY24 seems well within reach. And still, company A is available at rupees 240 per share, well below a fair value estimate of rupees 450 by FY24. Therefore, if things go as per plan, company A can go up 100% over the next 1 to 2 years. Making good money in company B, on the other hand, looks well out of reach, even after assuming a 10-fold jump in EPS over the next 2 years and awarding it a generous PE of a huge 30x. The fair value of rupees 900 comes well below its current share price of rupees 2100 per share. Yes, that's correct. The stock is trading at a premium of more than 100% even after assuming a very optimistic scenario. Therefore, it can be concluded that Mr. Market doesn't seem to be efficient in pricing both the companies. It is being too fearful in the case of company A and too greedy in the case of company B. Therefore, an ideal strategy would be to buy company A from Mr. Market and sell company B to Mr. Market. But what companies are these exactly? What is company A and company B in our analysis? Well, company A is none other than Coal India, while company B is Adani Green Energy Limited. Two businesses which currently find themselves on the opposite end of the spectrum. It is believed that company A will be a pale shadow of itself 10 years from now on account of the polluting nature of its product, that is coal, and company B will go from strength to strength on account of its focus on green energy. However, the question that we need to ask ourselves is whether Mr. Market is getting carried away while pricing these stocks. Is it being inefficient and therefore massively underpricing Coal India and massively overpricing Adani Green? Or the current prices of these companies reflect their true future potential? Well, a small valuation exercise that we just finished is giving the impression that a large cap stock like Coal India does appear to be undervalued and could turn out to be one of the dark horses of 2023. It could achieve what ITC managed to achieve in 2022. On the other hand, even a small negative development around Adani Green can send the stock price crashing, as a lot of future expectations is already built into the stock price. Is our analysis correct, or is there a huge chink in our valuation and efficiency and inefficiency theory? Well, it is difficult to comment about Coal India per se, but I believe that a portfolio of 25 to 30 stocks with the same fundamentals and undervaluation as Coal India has a very strong chance of outperforming a portfolio of 25 to 30 stocks with the same fundamentals and overvaluation as Adani Green. Going where Mr. Market is quite fearful and exiting where it has turned overly greedy has often worked out well in the past, and there is no reason why it cannot work out in the future. On that note, this is Rahul Shah signing off. Please do not forget to like and also comment on the video in case you found it useful. I'll see you again next time. Goodbye and take care.